In this second video on accounting for inventory, we're going to be discussing inventory cost flow assumptions. Note that we'll be using a periodic inventory here. So our example that we're going to start with is that we have Charlotte Company with a beginning inventory of 500 units with a cost of $1 each. During the period, the company purchased an additional 1,500 units at a cost of $1.20. At the end of the period, 200 units remained on hand. So what we want to determine is the value of ending inventory and the cost of goods sold. The answer is going to depend on what cost flow assumption is used. So if we take that information and kind of rearrange it, we can look specifically at the units first and then the dollars. So the unit information we have is that there were 500 units in beginning inventory. We purchased an additional 1,500 so that we have goods available for sale of 2,000 units. We do a physical count. We determine that there are 200 units left on hand, which means if we had 2,000 available for sale and 200 are left, we must have sold 1,800 units. So ultimately, what we have to determine is what is the value assigned to those 200 units in ending inventory versus the value assigned to the 1,800 units that we sold. So if we take this same information and do the same calculation but use dollars, the beginning inventory has a value of $500 because we had 500 units with a cost of $1 each. We purchased 1,500 units at $1.20, so the total cost of those purchases is 1,500 times $1.20, or $1,800. If we add those two numbers together, we get $2,300, and that is the cost of goods available for sale, which we can also abbreviate COGAS. So we had 2,000 units available for sale, and we had a total cost of goods available for sale of $2,300. Of the 2,000 units, 200 are in ending inventory and 1,800 are sold. So of the $2,300, what portion of that are we going to assign to the units in ending inventory versus cost of goods sold? And the answer is going to depend on the cost flow assumption. So the four that we're going to consider here are specific identification, FIFO, which stands for first in, first out, LIFO, which stands for last in, first out, and weighted average. Specific identification is not really a cost flow assumption because the company can determine which units were sold and which units are still on hand. FIFO, LIFO, and weighted average are assumptions because we're making an assumption about the order in which units are sold. So note here that that doesn't have to have anything to do with the actual order in which units are sold. So FIFO, or first in, first out, assumes that the units are sold in the order in which they were purchased. So in other words, we're going to assume that we sell beginning inventory first and then purchases in the order in which they were made. LIFO, or last in, first out, assumes that the units are sold in the reverse order in which they were purchased. So we would sell our most recent purchase first and work backwards to beginning inventory. Under weighted average, we're going to determine a weighted average unit cost based on what we paid for beginning inventory and purchases, and then we'll use that weighted average unit cost to figure out the value of ending inventory and the value of cost of goods sold. So bear in mind that companies can only use specific identification if they can identify exactly which goods were sold. So if Charlotte Company has a beginning inventory of 500 units and then they purchase an additional 1,500 units, we need to know which of those units were sold. So we have an additional piece of information here. Charlotte sold 400 of the units from beginning inventory and 1,400 units from the purchase. So recalling our unit calculation, we had 500 units in beginning inventory. We paid $1 for each of those. And so we sold, under specific identification, we sold 400 of those. So if we're trying to determine cost of goods sold, we're going to say 400 times $1, and then we sold 1,400 of the 1,500 that we purchased, and we paid $1.20 for each of those units. So our cost of goods sold assumption is going to be 400 times $1 plus 1,400 times $1.20, and that works out to 2,080. So thinking about what units are left in ending inventory, we would have had 100 of the $1 units out of beginning inventory and 100 of the $1.20 units that were from the purchase that we made. So beginning inventory had a cost of 500. We had purchases of 1,800. We had goods available for sale of 2,300. We determined that cost of goods sold was 1,800, and that leaves our ending inventory value at 500. So thinking about LIFO, FIFO, and weighted average, we do want to bear in mind that a company can choose any cost flow assumption for a given category of inventory. The choice does not have to depend on the physical flow of the goods. If we were a grocery store, we might want to price our perishable goods at FIFO and have it mirror the cost flow assumption. But if we wanted to use LIFO, we could do that as well. We could use FIFO for our perishable goods. We could use weighted average unit costs for our canned goods, and so on. So a company can choose whatever cost flow assumption that it wants to choose. Once it chooses a cost flow assumption, it needs to consistently use that cost flow assumption, but a company can use different cost flow assumptions for different categories of inventory. So FIFO assumes that the goods were sold in the order purchased. So if we have 500 units in beginning inventory and we purchased an additional 1,500 units, if we sold 1,800 units, under FIFO, we're going to assume that we sold the 500 units at $1 plus 1,300 of the units at $1.20. Under FIFO, first in, first out, the units in ending inventory are going to come from that most recent purchase. So our ending inventory is 200 units at $1.20 or $2.40. So one of the things you want to keep in mind is that the cost of goods available for sale is $2,300. So once you determine the value of ending inventory and the value of cost of goods sold, those two numbers should always add up to your cost of goods available for sale. LIFO assumes that the goods were sold in the reverse order in which they purchased. So under LIFO, where we sold 1,800 units, we're going to assume that we sold all of the 1,500 units that were in the purchase and then 300 of the units from beginning inventory. So we're going to compute cost of goods sold as 1,500 times $1.20 plus 300 times $1, or $2,100. The 200 units that are in ending inventory, under LIFO, we're going to assume that those units came out of our beginning inventory. So the value of our ending inventory is 200 units at $1. Under weighted average cost, we're going to take our cost of goods available for sale of 2,300, and we're going to divide it by the units available for sale of 2,000. And so 2,300 divided by 2,000 gives us $1.15. So our weighted average unit cost is $1.15. There were 200 units in ending inventory. 200 times $1.15 is $2.30. So that's the value we're going to assign to our ending inventory. And for cost of goods sold, we're going to take the 1,800 units that we sold, multiply those times $1.20, and get 2,070. So if we add those two numbers together, we do get our 2,300 cost of goods available for sale. So this was a very simple and straightforward illustration of cost flow assumptions. Typically, they're going to be a little bit more complicated because you could have multiple purchases during a period.